Hello and welcome. I'm Taylor Pearson, and this is the Mutiny Podcast. This podcast is an open-ended exploration of topics relating to growing and preserving your wealth, including investing, markets, decision-making under opacity, risk, volatility, and complexity. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, Mutinyfund, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. And listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making such a decision on the appropriateness of such investments. Visit www.rcmam.com/disclaimer for more information. In this episode, we talk with Tim Jacobson, founding member of Pearl Capital. Before starting Pearl, Tim worked with the family office and designed Pearl's investment program to add a much-needed form of diversification to their portfolio. In the process, he discovered many other investors had the same need. We talk about common mistakes investors make in evaluating the risk of their portfolios. We then get into details on why VIX futures is the best instrument to hedge against equity market volatility in Tim's opinion, as well as why the absolute level of the VIX is not as important as the fluctuation in the VIX, the volatility of volatility. At the end, we get Tim's take on what the post-COVID-19 world will look like. I hope you enjoy this conversation as much as I did. Tim, I know you previously worked at a family office. Maybe just start, a little bit of background about your career up to that point, and then, for listeners that aren't familiar, what is a family office exactly, and sort of how does that environment work?
Great, yeah, happy to be on the podcast today. So yes, I started my career at Franklin Templeton out of undergraduate. Way back in 2004. So I've been in the industry now over 15 years, 16, 17 years. And after I left Franklin, I did a couple of things in the hedge fund space, mainly researching hedge funds and in particular quantitative hedge funds. Because when I was at Franklin, I really kind of fell in love with that space. There was a quantitative team that I was a part of, and we were building out systematic trend following strategies. And so when I left Franklin, I always sort of carried with me that passion and that newfound curiosity in that whole space. I kind of equate it to scuba diving for the first time. You kind of don't realize that there is this new world or this different world that exists that you're not really aware of. Coming out of college, I always wanted to be a stock picker. But given the opportunity that I had, I kind of fell in love with it. Totally different style of investing, and I've never looked back since. So when I eventually hooked up with this family office in California, our job with my partners, Lawson and Alexandra, our job was really to build a decorrelating portfolio. A portfolio, in other words, that was going to perform differently than any other asset class. It was going to perform differently than equities. It was going to perform differently than credit or real estate. And it was meant to add some stabilization to their holdings. And so a family office is really just it's an investment vehicle designed specifically for a single investor. So it's usually a family that has significant wealth, and they're large enough to where they can employ a staff. Our model was a little bit different. Every family office kind of does things a little bit differently, but our model was a little bit differently, structured differently. But that's sort of the basic idea, is that the family has large enough assets to where they can employ their own advisors and professionals to help them either do the whole thing or a piece of it. And in this case, our job was to just handle this piece of the family's assets.
And talk a little bit how did you get to sort of that piece of decorrelated assets and volatility? What was sort of the journey? What was the sort of idea made, so to speak, of how you got there?
Well, that's why I give the backstory of my professional background, is because I've always had a passion for quantitative strategies, researching them, building them, selecting them, building portfolios out of them. It's always been something that's been very interesting intellectually to me as well as academically. And so when the opportunity came to do that with my partners Lasse and Alexandra, we were excited, obviously, to do that. So we had known the family for several years prior to us launching Pearl to do that for the family. And so, it was just a perfect opportunity for us to do what we enjoyed to do and also make a living doing it.
Coming from quant background, and quant's one thing, but why VIX and the VIX trading? Was it just that you were looking for those uncorrelated trades or a way to de-risk or lower the volatility of their portfolio? That's what led you to VIX trading, or why specifically VIX?
Yeah, fantastic question. So that goes to the second half of 2014. Listeners may or may not be aware of this, but in 2014, there was an interesting trend that emerged particularly in the dollar. And if readers want to know a little bit more about that, I'd direct them to our website, and in our publications tab, we just published a paper a couple weeks ago called Free Lunch and Trend Followers Are Buying. So free lunch is a reference to the famous adage that the only free lunch that exists is diversification. So we wrote this paper to talk about the benefits that CTAs, trend followers, have in portfolios. Well, in 2014, there was a strong move that the dollar made that set off a chain reaction in all other commodities priced in dollar. So gold made a move, oil made a move, agricultural commodities made a move, all in conjunction with this dollar trend. And the paper that I referenced that's on our website discusses that in a much broader picture and makes the case for why trend followers ought to be included in a diversified portfolio, and why they should specifically not be looked at as crisis alpha solutions. Leave that to folks like us and Mutiny. But that moment in 2014 sort of highlighted and underscored that dynamic, that these trend followers provide investors a certain kind of return stream, but it is not necessarily crisis alpha. And it is diversifying against equities, but it does not overcome the challenges of investing in equities, which are periods at times of significant volatility. So as we took a step back, we wanted to understand, is there an asset class that can provide us true diversification against the volatility of the equity markets, right? Not just something that behaves differently or gives us a different return stream or a different look, but we wanted specifically something that could directly benefit from increases in equity market volatility. And VIX is a fantastic instrument to do that. If you also go to our publications page on our website, we also have another article called Effectiveness of Commonly Used Hedges in U.S. Equity Markets, or some really long title like that. But basically, we go through and we look at various instruments and ways that people have tried to get diversification and crisis alpha against equity markets. We look at gold, we look at treasuries, fixed income, CTAs, even looking at safe haven currencies like the yen, things like that. And really, the VIX futures is the best instrument to deliver a real hedge, natural hedge against equity market volatility. I mean, hands down, it performs the most consistently against equity market volatility. It provides the most magnitude in terms of the ability to cover the volatility that comes to you from equity markets from time to time. So really, the VIX instrument stood out to us as something that was truly an opportunity to fulfill that particular need. So the long story short, I love it when people have a very long explanation and then they end it with, and a long story short, we ended up building our own program to suit our own particular needs, which was an asset class based investment, which could stabilize the portfolio, but also have the dual benefit of capturing returns during moments of equity volatility.
Yeah, it's long and short are relative, right? I guess we could probably talk for 6 hours about the answer to that question. So it was a short answer in a certain sense. And I'd love that you could expand. The VIX, the volatility index. People aren't familiar. How do you sort of explain the VIX, maybe to someone that's not familiar with it, and then just tell why, maybe intuitively, why does it make sense as a hedge? What is the VIX, and why does it make sense that it would be a hedge to equity market volatility?
Well, great. Well, I hate for this to turn into a shameless plug of all of our publications, but if you also go to our website under the publications tab, you'll find another paper we wrote called VIX Twain and Magic Mirrors. So what we're saying in that paper is exactly the answer to that question. What is VIX? VIX is nothing more than a mirror reflection of the amount of volatility that the markets are generating in that particular moment in time, plus or minus supply and demand forces that the market participants are creating. So in other words, if equity markets are volatile, the VIX will reflect that. If they're not volatile, the VIX will not reflect that. And what really prompted us to write that paper was fourth quarter of 2018. So in the fourth quarter of 2018, in that December month in particular, the market sold off 9%, which is a really horrendous month to be involved in equity markets. To be down 9% is a difficult month. Well, volatility, I don't even think got above 25% or 25 on the VIX. Maybe we got to 30 on the VIX. But certainly on the VIX futures, we didn't get above 25. And, people who aren't necessarily familiar with volatility and how it reacts, volatility does not necessarily mean market goes down, volatility spikes. That is a misnomer. Volatility is a function of the magnitude up and down and on a daily basis of the fluctuations and the movements of the price action in the S&P 500. So if the daily moves are up and down and they're very large, then volatility will go high, right? What we just lived through in March 2020 is a perfect example. There were a number of days in the middle of March where we were plus and minus over 10% in a single day, and not just one day, but that was a 2 or 3 day stretch. That is significant volatility. If the markets are just selling down 1%, 2% at a time, your end result could be a minus 9% month on the S&P 500, but it didn't come with significant volatility. And that's a very, very important concept for people to understand, is that negative returns do not equate to high volatility. High magnitude moves in the S&P 500 equate to high volatility. And so what VIX is it's basically just looking at the amount of volatility that's happening in the market through the eyes of the options market. But really, the eyes of the options market are glued to the amount of volatility that is being generated in the market already. So in a way, it's VIX is basically just looking at itself in the mirror. It's looking at what the market volatility is doing, and it's pricing it. And the options, people who are trafficking the options are basically taking that information and feeding it back into the way that they price options and what price they're willing to buy and sell and trade them. So really, it's just volatility looking at itself in the mirror is the way that I would categorize what the VIX is doing.
And a couple of add-ons to that. One is we always like to point out that, volatility doesn't mean it's only when the S&P goes down. You can have volatility if the S&P is spiking higher. It's like
Correct.
you point out, it's the magnitude of the moves. It just so happens the magnitude is usually on the downside. The whole stairs up, elevator down scenario. We're probably going to get to this anyway, but I like that you guys talk about the echo of volatility, and it reminded me when you brought up December Q4 of 2018. Talk about how you think about like the echo of volatility and how that affects volatility trading.
And let me jump in. Maybe let's just do
a
quick definition, Tim. I'll get you to explain a couple things. You mentioned sort of the VIX and VIX futures. Could the VIX itself is an index. It's not a tradable product. However, there are futures that are tradable. Could you maybe just explain a little bit how that works? And then I think what you mentioned, sort of the VIX spiking to 25 or 30, I think you can correct me. I'm sure you know these numbers better than I do. But historically, the VIX average is something around 20, and then maybe in the sort of the most recent low volatility period, 2012 to 2019, the average is somewhat lower than that, 12 or 15, or what sort of, just for people to calibrate?
Okay. Yeah. So what's the difference between the VIX index and VIX futures? We'll tackle that one first. So VIX index is not something that people can invest in. It's a reading, right? So Myron Scholes, or Fisher Black Myron Scholes came up with the Black-Scholes option pricing model years and years ago. And what that does is it's a theoretical mathematical model for understanding how an option should be priced. And it's quite technical, but at its core, what it looks at is the strike price, the price of the underlying security, in this case, the price of the stock or the S&P 500, the dividend rate, and other things. But there's about 5 or 6 variables. The one thing that you don't know, but which you can solve for algebraically, is implied volatility. So it's an ingredient in how much an option should be priced, or at what level the option should be priced. So VIX index is nothing more than taking a reading based on a basket of options on the S&P 500. It's going to look at the prices and the characteristics of those options, and it's going to impute or compute the level of implied volatility that's implicit in the way that those options are priced. So it's basically, VIX index is basically just a barometer or a thermometer that's measuring the amount of implied volatility that is priced into the market. Well, because you can't trade it, but because it is a very valuable, if you could trade it, that would be a very valuable instrument to be able to have. So SIBO, Chicago Board of Options Exchange, SIBO was very smart, and they said, well, let's create a VIX futures contract which would follow along the term structure of the VIX index. So the term structure, of course, is you have the VIX index at its anchor, and then every month out you have a series of expirations, and that's what we call a term structure, where you have a series of expiring contracts, and those prices, if you were to connect them with a line, would create a curved term structure. So you can trade the VIX futures, and that's basically a way that you can get exposure to the VIX index synthetically, or a derivative of it, if you will. So VIX futures are not going to always track exactly the VIX index, but it's probably the closest thing you can do to get an expressed view on the VIX index.
Great. And then, maybe talk a little bit about what are the historical norms for the VIX? What is a typical, what is the VIX historical average? When people are sort of calibrating a VIX of 10, a VIX of 40, how should people think about it?
Sure. So one of the calculations within the VIX is they times it by 100. And really what they're trying to do there is just make it into a usable, readable index. But why are they timesing it by 100? If you were to divide it by 100, what are they talking about? Well, if I were to line up a series of returns, daily returns in a spreadsheet on an asset, say the S&P 500 in this case, I could in Excel, and this is a very basic thing that any of us can do, we can go equals STDEV, open parentheses, grab whatever time series of daily prices that you want, close parentheses, and times it by the square root of 250 for 250 trading days. And that right there is going to give me an annualized standard deviation of market prices. In other words, in industry terms, we would call that the volatility of the market. Right there, over that time period measured, we're capturing and calculating a very basic style of market volatility. All right, so when we talk about standard deviations, what we're really talking about is volatility of the market, how much magnitude up and down the market is moving. VIX, and if I were to take that number and times it by 100, I could then put it on an apples to apples basis with VIX, right? So if I'm in an environment where the standard deviation of daily price returns of the S&P 500 equals 0.08, and I times it by 100, I'm basically saying 8% is my standard deviation of the market, is my volatility of the market. Well, then I just have to reference what VIX is telling me, and now we're on equal terms, if that makes sense. Right, so if you have the 0.08 realized volatility reading that we just calculated, and then you times it by 100, that would be 8. Well, VIX, a reading of 8 on the VIX, which we've never seen before, the 8 on the VIX would correspond to the 8 in the calculation we just did. So that's how the two are related. VIX, implied vol, and realized vol are related. Now, obviously, there's usually always a gap in those readings. Not always, but a lot of times there is, especially in those lower levels.
On average, sort of the historical VIX is something around like 20 or 15 to 20. Is that right? Do you know roughly what it's sort of averaged?
Yeah, so
over the last?
historically the VIX on the average, historically the average VIX is right around 20. But what we need to understand is that it's not an average that is always held to. In fact, VIX is a bit bimodal, meaning it has two averages that it likes to cluster around. So when you're in a low volatility environment, VIX actually likes to cluster around an average of around 15. And when VIX is higher, in a higher volatility regime, VIX likes to fluctuate north of 20. And I think it's around 25, if my memory serves me correctly. So yes, on average it's 20. But in reality, depending on the regime that you're living in, VIX will tend to cluster around that regime's mode or average. So in the years 2013 to 2019, that's why we saw VIX spiking and coming right back down. VIX spiking, coming right back down, is because VIX was doing a mean reversion around its lower regime average. But now that we've transitioned to a higher volatility regime, and again, another shameless plug, if you go to our publications tab on our website, we've published 2 papers in the last 18 months where we've talked about this transition of VIX and volatility to a higher regime, and it does that. VIX will move from low to high, from high to low. Volatility does that as well. So what we're now seeing, really since February 2020, people have noticed that volatility has stayed higher. It's not like it used to be where VIX spiked and then came right back down. VIX has spiked and it's staying there, and that's signaling to everybody. That should be a signal to everybody that we are likely in a higher volatility regime, much like we were in, say, 2000 to 2002, or actually really 98 to 2002, and then also from 2008 to 2012, where volatility stayed elevated for quite some time. It's our view that will be the case, that volatility will likely stay within the 20 to 40 range with movements here and there outside of those ranges. But historically, when VIX or volatility gets higher into a higher volatility regime, it tends to want to cluster around those ranges. We could be dead wrong. It's not like we're saying that that's what is going to happen, nor are we suggesting that people trade around what I just said. That's just for us an interesting thing to observe, and something that we think is helpful as a guidepost for people that follow our program.
And then, Jason, you ask about sort of echo volatility. I think this transitions well to that.
Sure, maybe. I always tend to get ahead of us a little bit too much, but I think you guys have written great paper on the echo of volatility, and I think maybe we can kind of jump ahead and talk about it in terms of what happened during the Ballmageddon in February 2018, and how maybe that leads to an echo of volatility during Q4 of 2018. Like you're saying, in December, if we're down 9%, but the volatility is not picking up, how it's almost an echo of volatility going to that October, December event of 2018. But let's kind of maybe backtrack and talk about Ballmageddon in early February 2018, what happened there, and then how that echo of volatility affects later on, throughout that year.
Sure. Well, it's always fun to talk about February 2018 because it's such a watershed moment for a lot of folks in the industry. As I mentioned just a moment ago, we were in a low volatility regime from 2013 to 2019, call it, but 2018 obviously falling inside that. And that was really an environment where people realized that you could just short the VIX or short the VIX ETFs and make fantastic returns year in, year out. And so everybody came on to that idea, and it's the old adage of wake up and sell volatility, right? So everybody and their uncle was coming into the markets every day and selling volatility, and it was getting to be an extremely crowded trade. 2017, record low volatility. We have to go all the way back to 1964 to see the same level of low volatility that the market saw. But even then, in terms of the number of days we stayed below certain levels, was a record. So that just goes to show how crowded that trade was. And we saw some shots over the bow, shots across the bow in 2017. There were a couple of really key days where people should have woken up and understood, hey, maybe it's time for me to not, get on the short vol bandwagon. One of them was in May 2017 when Trump fired Comey. The VIX really had a big move that day relative to the amount of selling that happened in the market. In other words, it wasn't a move. The VIX didn't have a move that was really merited by the amount of the sell-off. But I think what happened was you had some people that were shorting volatility. There was a move that was large enough that then forced people out of their positions. And so that was a warning shot. So the next day was August 2017 when Trump and North Korea got into a Twitter fight about who had the bigger button, if you guys remember that. It was the whole Rocket Man meme that Trump was on about. I think the market sold off about 3% that day, but the VIX went ballistic. It was just a very, very strong move in the VIX relative to the amount of selling in the market that day. Again, another shot across the bow that those that were in this crowded short trade maybe ought not to be playing that trade anymore. Well, fast forward then to January and February of 2018. That was really in the beginning stages of concern about the trade war with China. And I think for the first time, the market kind of woke up to the potential for a trade war. And on that February 5th, 2018, the market sold off 5%. Well, at that point, the entire VIX complex, the entire short VIX complex, basically had to unwind. And XIV and other VIX ETFs, because VIX doubled in the day, which is the largest percentage return we'd ever seen in the VIX. We'd never seen the VIX more than double in a day. When they had to then roll when they had to basically people redeeming out of that, it was a forced liquidation, and then it fed on itself. So with about 15 minutes to go, we were seeing the VIX was up about 8 points that day. But by settlement, 15 minutes later, it had doubled again to over a 17-point move in the VIX, which was the largest we'd ever seen up until that point. And unfortunately, there were a lot of casualties that day in the marketplace, and something that nobody should take lightly. That's a very concerning thing, and something that we never like to see. But that is the nature and the risks of markets, right? So VIX had its probably its largest move since August of 2015 on that one day, and that. At that point, we kind of thought, okay, well, maybe volatility is here to stay. But again, we were still in the middle of a low volatility regime, and so VIX was really wanting to come right back down. And so that's exactly what it did. Well, fast forward then to the fourth quarter of 2018, we started to see a little bit more volatility. Same sort of idea with the trade war and some concerns about that, as well as the Fed wanting to raise rates maybe a little bit faster than the market was prepared for. So a lot of different variables and factors coming into the scene. And so it sparked a sell-off. But what happens is almost like how a day trader might have different levels and place stop losses at different levels in the market, and basically what drives support and resistance in markets. So if the market sells down to a particular level where a lot of traders are sitting with buy orders, it can sort of hit that level, and then the market bounces right off of it. In a similar, not the same way, but using that as a metaphor, there are things not baked in, but there are some elements that get reflected in the way that volatility also behaves as it then makes a secondary move. So we all know what an echo is, right? We can echo, and then you get the sound back, and it's softer. It's an echo, but it's still a voice calling out. Well, when markets sold off in February 2018, that was the primary move. That was the first amount of volatility we'd seen in a long time, and it was a strong move. Well, when we came to the fourth quarter of 2018, it was a strong move, but it wasn't. It didn't come with a lot of magnitude. It was sort of a fizzling down. It was almost like the market was daring itself to cross certain thresholds, and so. And we see this a lot, actually. We see this in March of 2009. We see it in January of 2016, that you have a primary move in volatility like October of 2008, August 2018, February 2018. These are these primary moves in volatility where for a first time in a long time, or first time in a while, you have a massive move in the market that is unexpected, and there's panic in it, and there is concern in the price action, and you can see it, and it drives volatility higher, and and everybody can sort of feel that emotionally as that's happening. Well, things then tend to calm down or stabilize and consolidate, however the markets decide they want to do that, and then there's usually a secondary move. So March of 2009, that was the final leg down in the crisis. January 2016, there was another leg down to the same levels. And then fourth quarter 2018, same kind of idea. You're getting a secondary move back to these levels. And they usually just don't come with the same amount of volatility. There's not the same amount of panic. The initial shock is sort of worn off. And so when selling does occur, you don't get the same amount of panic and fear that you got in the primary move. And so therefore it sort of tends to be a volatility move that is much like the echo that you would get from the primary move.
So to think about it, in another way is like you said, February 2018 reminded people that VIX and volatility is a thing again because everybody had been complacent. So then in Q4, it's only, in October, it's only 8 months later. So when that move happens, people are it's fresh recency bias that volatility can happen again. So, and that echo of that move is much less than that Volmageddon in February 2018. But then what I find interesting is like how the different time cycles is then throughout 2019, maybe it's because of Fed policy in Q4 2018, 2019, vol becomes so suppressed again for a year plus that everybody almost like forgets about volatility or assumes Fed intervention is never going to bring back volatility. So then in March of 2020, what we just experienced, February, March, is that volatility spikes so dramatically because there's no echo before it because of maybe government intervention and then they immediately unbelievably suppressed volatility in 2019. So we get that spike in so far this year. But then how do you think if we have another, like we bounce back, obviously we had a V recovery or whatever we're going to call it. How do you think of that echo of volatility if we have another leg down in Q4 this year? Is it the same where you think it's going to be a muted echo, that softer vol move, or how do you think about that?
Well, let me use a different metaphor. I probably should have done this first. Imagine you are on a battleship in the middle of the Pacific, and your job is to look at radar. And you're looking at it day after day, and it's just the most boring job on the planet because nothing is showing up on your screen. In a primary vol movement, all of a sudden, there are 1,000 red dots or one giant red dot, and it's headed dead center, and it's going right for you. And all of a sudden, your adrenaline hits, and you're afraid, and everybody on the ship scrambles, right? That is the primary vol move. And now you're going to deal with that. Now you've got to deal with that crisis. Now you've got to deal with that situation. Well, let's say it turns into a battle on the battleship, and guns are blazing, and everybody's dealing with that situation. But if that battle rages on for 4 or 5 days, or in this case, let's say it rages on for 4 or 5 months, you're looking at radar and nothing's new. You're dealing with that situation, and now you're in the mode that is the current vibe of the market. And so there's not the same panic, there's not the same adrenaline flowing. You are dealing with that situation. I think that volatility, I should say, is very much the same sort of idea, that it only surprises you when it surprises you. And then when it's on the radar and you're dealing with it, there's no more real surprise. It's going to take. Now imagine if you had dealt with that crisis on the battleship and you've made those thousands of red dots dwindle down to 100, but then all of a sudden you see 1,000 more come and they're coming from a different direction. Well, now that's a new primary volatility regime, right? That's new panic, that's new fear that you're going to now have to deal with. So I kind of look at it that way. I kind of look at volatility like a radar would. And if anything's coming at you that wasn't there, and it's coming at you all of a sudden, coming to you dead center, that's a primary vol movement. If it's still on your radar and you're dealing with it, even if it comes closer to center, that's likely to be more of an echo vol or a secondary vol movement.
It makes me think of, as you're talking, I was thinking of reading accounts of the Battle of Britain when the Nazis, the Luftwaffe, was bombing London. Kind of there was that first week or two, everyone was freaked out, as you would expect to be when your city's being bombed. But I think within a few weeks, right, everyone, it was just like, this is what happens, right? Like, we're getting bombed by the Germans, and like normal. That's how life proceeds, and like I still have to eat lunch, and I still have to
keep
do
calm
whatever.
and carry on.
That's right.
That's exactly
it's interesting
right.
how that human psychology works.
And that's where
exactly right.
That phrase comes from. Keep calm, carry on. Exactly from that time period.
Exactly.
And we've all experienced it recently with coronavirus. Of like the initial panic, like it was just like, your adrenaline's rushing, and now it's become the new normal, and that's how we adjust to it. But going back,
Jason, just to interject on that, I mean, what were we all reacting to early in March was the case count, right? The case count was raging higher, and markets were selling off in relation to that, and people shutting down. Well, today, on June 25th, we're in the same situation. We're getting record case counts, and the market's up 30 points today, 40 points today.
That's a good point.
Right. It's the exact same thing. People get accustomed to the new normal. Now, let's say that the situation changes and all of a sudden we get a dollar crash and the Europeans decide that they don't want to be invested in US equities anymore. They're going to bring assets home and the dollar crashes, and then the dollar crash begets the Europeans pulling more money from US equity markets. Now that's something new. Now that's something we all need to be concerned about. That wasn't a part of that wasn't part of the coronavirus pie,
Right.
right? That's another pie in the face that we're going to have to deal with.
Exactly. And so earlier you referenced, there's almost like it's a bifurcated or two regime VIX market where it's either low vol or high vol, and we can cluster at this high vol for extended periods of time or years. So we can kind of get into how do you play that environment. But maybe we should take a step back for a minute and talk about, you guys specialize in what we colloquially call the VIX ARB, or the relative value VIX trade between the VIX and S&P. So far we've only primarily been talking about the VIX, but let's talk about VIX and S&P, and how do you think those two interrelate, and then how do you kind of trade off, or the relative value pairs trade between VIX and S&P?
Yeah, super. Well, as we spent probably too much time talking about earlier already, the relationship between realized vol and implied vol, meaning the volatility that the market is actually generating. We went through that thought exercise of doing that in Excel. And then we talked a lot about how the VIX is calculated using the implied vol from the options market. Well, we also talked about how the those two volatilities are very closely related, and how it's like VIX is looking at itself in the mirror through the eyes of the realized volatility. So the two volatilities are very highly correlated. You can calculate some very basic measures of volatility of the two types of volatility and chart them using different time periods and look back periods. And what you'll find is that there's a very strong correlation between the two types of vol. But
and if I can interject quickly, I'll give my very simple explanation of realized versus implied volatility. You can correct me where I'm wrong, but realized volatility is a measure of, as you were talking about doing the Excel and the standard deviation. You're looking at changes in price of some underlying, the S&P, whatever it will be, and you can calculate how much volatility actually occurred. And then implied volatility is based on the price of options. So generally the logic would be, if people think something very bad is going to happen, they're more willing to pay a higher premium to have the protection offered by options. And that implied volatility, it's being implied from the price of that option is thus higher.
Or
exactly.
Simply put, realized volatility is historic look back, and implied is looking forward.
People talk about it that way as well. We sort of think that they're concurrent, because you don't get implied without knowing realized first. You have to have a reference point. So it's a bit circular and a little bit of a feedback loop there. But that is the way that a lot of people talk about it. So yes, the two types of volatility are very highly correlated, but it's not at a constant relationship. That relationship is constantly in flux. Why? Because people have emotions. Market participants have emotions. Even people who build systematic strategies build them with their emotions in mind of what they're willing to accept in terms of risk and return, and what they're going to value in terms of how they want those trades to behave. So there's a human element throughout all of markets, whether it's systematic or discretionary trading. And so there are the emotions of fear, greed, and complacency that govern much of the price action. We believe this is very much a behavioral dynamic that exists between implied and realized volatility. It is governed by human emotion. And so when people get concerned and they're fearful, that's gonna push implied volatility to a particular relationship with realized. When they get complacent, that's going to push it to a different relationship. And when people get greedy, that's going to push implied volatility to a different relationship as well. So you can actually see, if you were to chart the two types of volatilities against each other, you can actually see the emotion and the sentiment of the market and how it's shifting and dynamically breathing and ebbing and flowing. And it's fascinating to see that. And then to also overlay that onto the price action of the market, you actually begin to see an interesting picture. And that is that implied volatility tends to trade at a discount when markets are in panic mode. And implied volatility tends to trade at a premium when markets are rising. Why would that be? Right, why would that be? Well, it's our view that, and it's one explanation, and there's probably others as well, but it's our view that if you are if you're driving along in your car and you knew that you were not going to get into an accident, and you were very confident of that, you were feeling kind of greedy or complacent, you would want to be a seller of car insurance, because you're going to collect a premium, and no one's going to get into a car accident, and you're going to pocket that premium. But if you knew beforehand that you were going to get into a car accident, you'd want to be a buyer. You'd want to shell out a little bit of a premium to get a larger payout, right? You'd want to be a buyer of that insurance. So why implied volatility acts sort of like the buyer or the seller of insurance versus the outcome, which is the market. And so it's that dynamic, that same behavioral dynamic which governs the reasons why people purchase insurance in other markets, we believe is a very similar dynamic governing why people would want to purchase or sell insurance in market insurance.
And knowing
I like the car. Go ahead, Jason.
We both like the car analogy. That was a good one. But thinking about, that's your overlay on how you think about implied versus realized. But then let's talk about how maybe it gets expressed in that trade, what we colloquially call short, or long. Let's talk a little bit about what that means when you're short VIX, short S&P, or long VIX, long S&P, and then how you ratio those trades, and then thinking about it with this overlap of implied versus realized volatility.
Yeah. So in moments when you have a view that implied volatility is higher than realized, you'd want to sell the more expensive asset, right? And you'd want to purchase the cheaper one. And then you're trying to collect on the difference or the convergence between the two types of volatility. So yeah, in moments when implied volatility is higher, you'd want to be a seller of the more expensive, which we claim would be the implied volatility. You'd want to sell the VIX. But we don't want to sell the VIX naked, meaning just sell the VIX and have that be our only position. We would want to sell that and hedge that completely with the other leg of the trade, which in the way that we structure the trades, we're trying to use the E-mini as our proxy for being long the volatility. So Jason, earlier you said, yes, it's true, volatility can go up as markets go up, or volatility goes up when markets go down sharply. It's sort of that stairs up, elevator down. And yes, it's true that volatility typically increases when markets go down, right? But not always. So it's not a perfect trade, but it's a very good natural hedge to want to go short the market against a short VIX, because what you're effectively saying is if volatility spikes, more often than not, it's going to come with the market going down. So I'm effectively long or synthetically long realized volatility when I'm short the market. And so VIX and S&P are naturally inversely related to each other. So if I'm short one and I'm also short the other, because they're negatively correlated and they move inversely to one another, you're effectively hedging that position. And again, it's not a static hedge, it's a dynamically moving target as to how much E-mini per unit of risk, per unit of VIX that you want. And that's also part of the science and the art behind what the trade's about, is understanding what hedge ratio do you want to set against those two assets. And then the same thing is true when you have a view that implied volatility is cheaper. Well, you want to go long that VIX. You want to go long the cheaper asset. And then I want to synthetically short realized volatility. Well, if I'm long the market and volatility spikes, more often than not, not always, but more often than not, that spike in volatility is going to be markets going lower. So me being long the E-mini is effectively being short realized volatility. So I'm going to go long implied by going long the VIX, and I'm going to go short realized by going long the S&P. And again, that relationship is going to be in flux and needs to be dynamically adjusted to always maintain market neutrality. So that's one way that you can structure a relative value market neutral trade between implied and realized, Paul.
And like
Going
you said,
back to your car example, it made me think. I think that the statistics, something the majority of accidents happen, I think, within 5 minutes or 5 miles of your home. I think some of that is due to kind of like base rates, right? Like most of the time, you're driving a lot, you're in that area a lot, but part of it is you get overly familiar, right? Like I took a road trip with my wife recently. We were driving through Florida. If you ever drive through the tropics in the summer, you have those huge rainstorms where it just comes down and it's just like blinding rain for 15 or 20 minutes. And, that's obviously a dangerous situation. But I'm like, I was very aware, right? Like I turn on my flashers and I got both hands on the wheel and I'm paying a lot of attention. Whereas, when I'm 2 minutes from my house, I'm just, I'm more likely to reach into the center console and see if I can find my audio jack. Right? I'm thinking like, oh, this is fine. I drive this road all the time and do this. I guess that was an interesting. That's the scenario. When I'm close to my apartment or close to my house, I'm underestimating volatility. I think, oh, nothing's going to happen because I'm nearby. When I'm far away, I'm in some weird environment. Now I'm overestimating, right? Because I'm hyper vigilant and I'm hyper aware.
You're perfectly describing complacency.
Right.
And that I think is what was the undoing of so many in February of 2018 is the complacency. And I think that a complacent environment is way more dangerous than a volatile environment. Because as you just said, in volatility, we know what to do. We put 2 hands on the wheel, we increase the speed of the wiper blades, we slow down, and we move to the right. Right? We all know what to do in volatile environments. It's the inflection point. It's when we're complacent and we're feeling like nothing can go wrong, everything's going our way. That's when you need to be very, very careful.
And then going back to this relative value trade between VIX and S&P, the majority of the time, for lack of a better term, you're going to be in that short trade, short VIX, short S&P, because part of that trade, one of the secret sauce is getting the ratio right of contracts in VIX versus S&P, and everybody has their own way of looking at that. But part of that trade as well is the roll down premium in VIX when you're short the VIX. We brought up term structure earlier, but can you talk a little bit about that kind of roll yield or roll premium in the VIX when you're in that short trade, which allows you to be market neutral, but maybe collect some of that roll down premium?
Yes. That is something that could potentially be playing into returns, although we've done some analysis to where we don't believe that we're correlated to that roll down yield. But it is a factor that does need to be accounted for and can be, as you just alluded to, something that is a tailwind at your back, given how you're positioned. So as we talked about the term structure of VIX, meaning so right now the July contract is the one that's set to expire next. And then after that, you have the August contract, September, October. Well, right now, it's a pretty flat curve, but in a normal environment, what you would see is July would be priced the lowest, August would be priced a little bit higher, September a little higher than that, October a little bit higher than that. And of course, VIX index being priced the lowest of all of those. And so this idea of roll yield is that as contracts come into expiration, they're going to tend to want to converge to what the VIX index is, so that on expiration day, or at the moment of expiration, they're effectively working towards being equivalent to VIX index. And there's reasons why that doesn't occur, but that's a much longer discussion. But it will tend to converge to the price level of the VIX index. So that's what that roll yield is. And so if you're short the VIX in an environment where it's converging from high to low, well, you've got something that's in theory at your a tailwind at your back, because it's naturally wanting to go lower towards the VIX index. And so you've got something that's built in to maybe help you get there on a short trade. But we do not view what we do as anything to do with the roll yield. We use the front month contract to express a view on implied volatility, but we are not using it because we believe we're trying to capture some sort of roll yield. But it could be something that helps you in the trade.
Yeah, it's an excellent thing to point out is that this is why people get carried out on a stretcher on VIX, because I think historically they look at that roll yield and everybody's trying to capture that roll yield. And a lot of times they're going naked short VIX to capture that roll yield. And then when VIX spikes, they get their face ripped off and they're out of the game. So yeah, it's a dangerous game. But like you said, it can be a tailwind or a headwind, depending on what trade you're in and then what the ratio is. And it's just it's just another factor in the game overall. And whether that implied and realized is expanding or contracting, it's a very, like you pointed out earlier, it's always undulating, it's dynamic, and it's just interesting to kind of watch on a daily or intraday basis.
And I think that's why for us it's so important to understand the valuation between implied and realized. That is for us the most important thing to understand, because roll yield is high or low. That it has something to do with it, but not really at the same time. VIX, the term structure can move on you, and if that's your only input, if that's the only thing you're looking at, then that's a problem, or that can become a problem.
No, I was just going to add, I think the term structure and futures can be a bit confusing, but at least in the context of VIX, it sort of makes an intuitive sense. If, we're in a low volatility regime and let's say the VIX is at 15, as you go out into the future, 1 month, 2 month, 3 month, the next contract might be at 16 and 17 and 18 because the future is uncertain. So there's sort of a premium there. And then if nothing changes, as Jason was saying, there's sort of that 18 3 months from now is going to converge to 15. It's going to drop down. So if you're short the VIX, you're able to make money on that trade. Obviously, as you said, that's a lot of people look at it, they're like, oh, this is great. I think if you looked at some of those short volatility indices that blew up in 2018, they looked just this like perfectly steady return stream for every month they were making 1%. It's like, oh, this is like free money, right? It just always goes up 1% every month, very low volatility. And then, they lost all of that in, a single day.
And I just remember something else I wanted you to touch on real quick, Tim, is that as we transition to a higher volatility regime, a lot of times that can hurt options traders because they're paying up a higher price for implied volatility. They can still do well. It just reduces maybe the convexity of an options trade, but that's totally different when you're trading like VIX and S&P. Is you can tailor your trades to a high volatility environment and do exceedingly well in a high volatility environment or even a high volatility environment as volatility starts whipsawing around.
Yeah, really it comes down, for us, what we like to see is oscillation. If prices are stagnant, it's very difficult to capture any sort of relative value. But if there's oscillation and there's maybe even confusion in the marketplace as to what the proper valuation is, and there's great debate among market participants about what the valuation should be, that's a great environment because now you're going to get larger opportunities by virtue of that greater oscillation. Greater price moves equal greater opportunity. So yeah, the level of the VIX is not as important as the fluctuation in the VIX.
And Tim, I think those are the main things we were hoping to cover with you. So thank you very much for your time, and that was a great conversation.
Well, if we can do an appendix to this session, I think listeners may want to know about the first email I ever got from Jason.
Yeah, no, let's do the appendix.
Okay, well, so I grew up at Brigham Young University football.
I'm actually
fan,
slightly terrified of this, by the way, because I don't actually know the backstory, but I do know Jason is there's a great volatility in his emails, so this could go, there's a lot of ways this could go. But sorry, go ahead.
No, it's all right. So I grew up a BYU football fan, right? I'm a child of the 70s and 80s. And BYU football was in its absolute glory days during that time period. In 1980, we had Jim McMahon as our quarterback. A lot of people don't realize he went to BYU. Jim McMahon is a BYU guy world. Everybody needs to understand that. Then we had Steve Young. Some people may recognize that name. Steve Young was our quarterback in 83. And then in 1984, we won the national championship. Things could not get any better for us as fans. Around that time, there was a guy named Jason Buck, who was our defensive end on the team. And he's got an amazing backstory. He actually grew up on a farm in Michigan, and his father lost the farm. And for a while as a child, he and his family lived under a tarp, or basically a makeshift house made from a tarp in the side of their car. He worked his way through high school and got a job to save money for college, and eventually joined the junior college team at Ricks College up in Idaho. Just an amazing backstory. I mean, this man is such a hero in my eyes, and for a lot of different reasons. So Jason Buck eats quarterbacks for lunch. He goes on and has a great career in the NFL. He's a famous alumnus for BYU football. And I get this email from Jason Buck saying he's interested in our investment program. And I'm just thinking to myself, somebody pinch me. I must be dreaming that Jason Buck wants to hear all about what we're doing. But turns out it's a different Jason Buck with an equally interesting backstory. And I don't know, if the listeners don't know Jason's backstory, maybe you should turn the tables and ask Jason his backstory.
I was going to say it's quite the opposite. I was so sorry to disappoint. I think even also just as interesting is the first time we met in person. We actually ended up being seated next to each other at this like highfalutin Italian dinner in Miami. And it's a classic line of a Mormon and agnostic sit down for dinner and talk about Amazonian tribes and their beliefs in afterlives.
Yes, I've actually read that book. What is it? Don't Sleep, There's Snakes?
Yeah. We ended up talking for hours, about the origins of language and whether we're a tabula rasa or not. And it was a conversation I won't forget, and I enjoyed it thoroughly. But it was one of those things where on first meeting, 3-4 hours later, we're still talking about the existence of God or the ontology of the world we live in. So it was fantastic. A first meeting, very different from usual first meetings. But also, I highly encourage any listeners to, as you heard Tim bring up many times, a lot of the content they put out on their website is fantastic. They've written tremendous white papers. And lately, on a lot of your newsletters, you've been referencing or overlaying the Hoover era for what we're going through now. And those have been just tremendous. Have you guys turned that into a paper at all yet, or is that part of the newsletters? And can outsiders get access to that, or has that only been internal thus far?
On our website, we've published a paper called Echoing the Times of Hoover that you're talking about. And yes, there are a number of parallels between 1929 and today. It's a good read. I mean, we're not calling that this is a Great Depression, but we're just highlighting the parallels that were then and now. And there's other parallels as well. I think others in the industry have also picked up on the parallels, and we've since seen some people talk about the global travel industry as a parallel. So for those that don't necessarily know what I'm talking about, really from World War I, Europe wasn't able really to produce its own food. And so here domestically, there was great demand and higher prices to support it for U.S. farmers to produce and export agricultural products. And so it induced a lot of the independent and family farmers to take on debt, buy land, buy farm equipment, expensive tractors so that they could boost yields, boost output at higher prices and do very well. Well, when the war ended and Europe got back to producing their own agricultural products, it took the floor out of U.S. demand. And over the next decade, we know the story. I mean, even before the 1929 crash, Congress did a lot to try to hold up and prop up the agricultural industry. So one of the parallels we draw to that is the U.S. Oil industry. in that it relies on elevated prices in order for them to be able to produce at a profit. I think another one might be global travel. There's Airbnbs, Ubers, Lyfts, lots of people making their careers around those types of things. Airlines. I mean, there's a lot to do with the global travel industry as well, which I find another manager bringing that point. I think that's very interesting. But yeah, there's danger to when prices fall out. There's danger to look to those industries that are levered, that have borrowed. I mean, if you bought Airbnbs and you're planning on filling them up, and now all of a sudden there's not demand and there's not well, what are you going to do? You don't have demand, you don't have revenue, and you've got to service that debt. That's a scary situation. If you're an oil producer, you've gone out, you've got expensive fracking equipment to be able to explore and harvest oil in the shale industry. That requires a high price in order to service that. When price falls out, what are you left with? So there's a number of parallels of the lead up to both situations. COVID just simply was the catalyst, much like the market crash in 1929 was the catalyst to kind of waking everybody up to it. But then you had the Fed coming in huge in 1929. The only other time in history that central bank balance sheet expanded to the same level was, you have to go all the way back to the early 1700s, to the War of the Spanish Succession, which, by the way, if you're going to name a war, I highly recommend the War of Spanish Succession as a name for a war. I think we should name all of our wars this way.
It's like the war of Northern Aggression that Taylor knows.
Yeah, War of Northern Aggression, exactly. That was on the back of it. So, and then in 1709, you had a frost that killed prices and harvests in England as well. So you had kind of this global upheaval all happening at the same time. Well, you have to go all the way back to 1700s before you see the central bank balance sheets expanding to the same levels as they did in the Great Depression, at the same levels that they are now, even more so than 2008. And we're on track probably to see the Fed's balance sheet expand to upwards of 40% of GDP, possibly by 2028. We're on track. I haven't checked it in the last few weeks, but I wouldn't be surprised if we're closing in on 30 or 30% plus on balance sheet exposure to GDP. So also the response from Hoover was they wanted to do everything they could to keep people's jobs. They wanted to support wages. We have PPP. There's just a lot of parallels to the buildup, the reaction of the moment, the response to the Fed, response of government. It's all very similar. I would say that because we've learned our lessons, hopefully, maybe it won't be as bad, but I don't think that people can deny the severity of the situation that we're going through now. I don't believe it's over. I have a hard time. Now, people need to understand we trade everything systematically. We're not discretionarily doing anything. But I look at these things and I form my opinions on them. I just don't see how the world goes back to normal. Let's pretend today, June 25th, that COVID does not exist. Let's pretend it does not exist. Is the economy at 100% what it was 6 months ago? No. And so I don't believe that all of a sudden, just because we find a solution to COVID or people get back to work, that means the markets are going to go on to all-time highs. I could be dead wrong. That's the beauty of what we do, is we're agnostic to market direction. But in my view, I just don't see how it's possible, given all that we've seen, for things to just quote-unquote go back to normal.
I think that's a perfect place to end on that polymathic crescendo. Thanks, Tim, for being on our blog. We'll circle back to doing another podcast when you release some of the new great products you're working on. But thanks again for being on it, and we hope everybody enjoys. And please check out his website as you heard on this podcast. The papers are fantastic.
Thanks, Jason. Thanks, Taylor. Really appreciate it.
Thanks for listening. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com, or better yet, drop us a message. I am Taylor at mutinyfund.com, and Jason is Jason at mutinyfund.com, and we'll get back to you. You can find us on Twitter at mutinyfund, and I am at Taylor Pearson, ME.